This is the Nedgroup Investments podcast, where we explore a variety of views and insights that investors care about.
Hello, I am Trevor Garvin from Nedgroup Investments Multi-Manager. This installment of your market and economic wrap is titled Interest Rate Cutting Cycle Starts in Earnest. The US Fed, followed by the South African Reserve Bank, both cut rates. The South African Reserve Bank Monetary Policy Committee has elected to cut South Africa's interest rates by 25 basis points. This marks the first time since May 2023 that the committee has changed rates, and it is in line with economic and analyst expectations. The repo rate is now sitting at 8%, and the prime lending rate has been cut to 11.5%. The decision to cut rates was unanimous. The rate cut comes in the context of lower inflation in South Africa, as well as global central bank moves, mainly the US Fed, which cut rates by 50 basis points on Wednesday. According to the South African Reserve Bank Governor, the MPC members considered an unchanged stance, a 25 basis points cut, and a 50 basis points cut. The MPC ultimately reached consensus on 25 basis points, agreeing that a less restrictive stance was consistent with sustainably lower inflation over the medium term, he said. The governor said that the forecast sees rates moving towards neutral next year, stabilizing slightly above 7%. This implies another 75 to 100 basis point cuts to come. Decisions of the MPC will continue to be data-dependent and sensitive to the balance of risks to the outlook of inflation and economic growth. The governor noted that there are scenarios where inflation could undershoot the baseline forecast, namely lower oil prices or the exchange rate appreciates further. However, he warned that conversely, inflation could be higher than our baseline forecast given scenarios such as higher housing costs, larger electricity price increases, or wage increases that outrun inflation and productivity growth. Food inflation also remains a source of uncertainty, despite recent improvements. Global conditions pose additional challenges. Geopolitical risks are heightened and could generate further economic shocks. Policy uncertainty is also elevated in various parts of the world. Both trade restrictions and debt levels are rising and might go much higher. The South African Reserve Bank sees inflation remaining below the 4.5% midpoint of the target range throughout the forecast period of 2024 to 2026, the next 3 years. For the year ahead, headline inflation is expected to average 4.6%, lower than the 4.9% that they forecast in July this year. Economic growth was marginally below the Reserve Bank's expectations in the year's first half. However, output is now expected to edge higher in the second half of the year, with growth of 0.6% in both quarter 3 and quarter 4 expected. The short-term outlook is premised on improving confidence and to some extent increased spending following withdrawals from the two-pot retirement system. Over the medium term, the Reserve Bank expects growth to be strengthened by better functioning rail and port networks and broader accelerations in structural reforms. The 2024 GDP forecast is unchanged at 1.1%, while the estimates for 2025 and 2026 were revised higher to 1.6% and 1.8% respectively. This is an improvement in GDP growth to the past number of years, but ideally government still needs to be pushing towards growth in excess of 2.5% to 3%. In summary, yesterday's decision was widely anticipated, given inflation's rapid descent over the past 3 months, falling just below the SARB's 4.5% target in August. The Fed's decision to cut by an aggressive 50 basis points probably sealed the deal, removing any lingering concerns over the outlook for the rand. The rand rallied in the run-up to the Fed's meeting and strengthened even further this morning, trading at 17.43 to the US dollar. With the US Fed signaling quite an aggressive rate-cutting cycle, global risk appetites should improve, buoying emerging market currencies. If South Africa can progress further with structural reforms and place the country on a firmer fiscal footing, the rand should continue to hold relatively steady. That brings us to the end of today's market report. We are at the beginning of a new economic cycle, with lower rates boding well for possible strong equity market returns in the future. Till next time, with thanks, Trevor.
Nedgroup Collective Investments is an authorised collective investments scheme manager in terms of the Collective Investments Schemes Control Act. Nedgroup Investments does not provide advice on financial products and will only give you factual information. For further details on our funds and to view our terms and conditions, please visit nedgroupinvestments.co.za. Nedgroup Investments. See money differently.